bond market seeing its biggest rally since July, with the 10-year dropping to around 4.2%. But as investors digest the latest read on the economy, are these gains sustainable? Joining us now to discuss, Janet Rilling, Allspring Global Investments Senior Portfolio Manager. Janet, great to have you on. As you know, the 10-year yield on track for its 7th week of declines. What is the price action telling us about the health of the economy?
Morning. Yeah, I think that the bond market has been watching the fiscal headlines pretty closely and trying to understand what the second order impact is. And given there's a large degree of uncertainty, I think that is weighing on the view on economic growth. We are still constructive on growth for this year and think it will be positive. But given the uncertainty, we know that corporate leaders are starting to slow play some of their strategic decisions, maybe merger and acquisition activity, maybe CapEx investment. And that does lead to a lower view in terms of growth outlook.
And so what do you think a better estimation or better kind of outlook for that growth is potentially kind of more tempered at this point?
Yeah, I think still achieving 2 to 2.5% growth is possible, but that is a deceleration from what we saw in 2024.
To what extent do you think that policy from the White House is driving some of that movement? I've heard sources arguing on both sides of things that the policy is just noise. The slowdown was already in the market prior to that. That's what Neil Dutta has to say. Whereas others say that the tariffs and the sequence of policy, with tariffs coming first prior to tax cuts, is going to weigh on growth. What do you think?
Well, the direct impacts from policy are not yet in the numbers. We are still waiting for some of it to be implemented. It then takes time to work its way through the economy. So I think the effects we're seeing now are more on sentiment, the anticipation of what the tariffs mean, and then also from the consumer standpoint, maybe a bit more uncertainty. I mean, the job picture is strong for the consumer, and a consumer tends to spend when they have a job. But there is an increased level of uncertainty. I mean, if you think about DOGE and some of the cuts in government, while many of the government workers will retain their jobs, it has increased uncertainty for them, and they may cut back a bit on spending. So I think just this level of uncertainty is impacting not only corporate decision makers, but consumers in their decision making. As we get a little more clarity on policy, that may take that element off the table. However, we will then start seeing the effects of the actual implementation. And I will say, it's not clear that these policies will have a negative impact. They are complex. They some may add to economic growth, others may detract. And so it's a really uncertain environment when you try to net all these items out. And in our view, just a little too early to have good clarity to predict.
It seems like the consensus is that the policy will still have and some larger kind of implication for volatility. And with that volatility, we've heard calls, even from UBS this morning, saying it's time to be bullish, acknowledging that the volatility is going to stem from that policy and the will they or won't they of tariffs, and then what will that do to the economy, and then what will the Fed do? What, from your best gauge, is the best kind of animal spirit for investors to employ right now?
Well, first of all, from a fixed income standpoint, we do think now is a good time to allocate some of your portfolio to fixed income. And that's because the overall level of yields is higher than it's been for quite some time. In terms of the volatility, we do think it's going to be elevated because the range of outcomes is wider than it's been for some time. But that said, you can take a longer term view, set your allocation, and then shift your portfolio in an active manner to the sectors where there's a bit better valuation. So for us, we're emphasizing, for example, structured product in our portfolio. Here, we think the valuations are a bit better in the current environment. But it's this idea that you do want to have the longer term allocation to get that ballast in your portfolio. Duration serves at times as a cushion to equity market volatility. And we think having that foundational allocation in an investor portfolio is important.
Janet, thanks so much for taking the time here with us just after the opening bell. Appreciate the insight.
Thank you.